right. Happy Thursday, everybody. Welcome to Beyond Stocks. Pedro and I are very excited to welcome Drew Walgren to the show this morning. He is with MAG Capital Partners, and Pedro and I ran into him a few months ago in the Dallas-Fort Worth area at some networking events, and he and his firm have a very interesting business model, and so we're happy and excited to share this with you today. So, Drew, let's start with your background. How have you ended up where you are today?
Yeah, hey, great to see you guys. Thanks for having me on board. I go back to an entrepreneurial background. Actually, when I was at the age of 20, a friend of mine were running a company, a small business, beverage and food distribution company, and we had the opportunity to buy it from the owner who we ran it for. And that was my first entry into business ownership. So love that. Fast forward, great financial crisis happens. My clients were delis, cafes. I used to come up to them and look up, and they were boarded up. It was a crazy time. So we didn't lose money on it, but I remember trying to sell that business, and horrible time to try to sell. I mean, I was calling my competitors and saying, "Hey, I'll give this to you for cheap," and they just said, "Nope, we're holding every dollar of cash we have." But I went into a corporate career at Liberty Mutual Insurance in a consultant role on their claim side. But in the meantime, had started to buy and fix up properties in the Bay Area, single family homes, and kind of find that decision point, right? Where you go, do I want to hold now, right? I can continue to expand this. And I had a lot of opportunity in my career, and I said, I don't have time for this, right? It's great, but what can I do here? Stay in real estate. And so I started to invest passively. I was introduced by my brother, who was at a real estate investment firm. They used to raise capital and partner with good operators, rinse and repeat with 3, maybe 4 operators. And one of those was MAG Capital Partners, actually. So he introduced me to them. I actually was investing as an LP with them, as well as some other groups. And then some years later, my brother was kind of unhappy where he was at, and I was ready for a change, and found myself sort of plateauing as I had risen through some ranks at a big corporation. And you find yourself waiting for someone to retire or die, right?
Yeah.
So it looks a little bleak at a certain point. And I said, yeah, I'm ready for a change. So we set up our own shop and raised some capital for a deal in partnership with MAG Capital Partners. And right after we were done, we said, hey, you guys, this is more messy than it needs to be. Let's we'll fall under the MAG Capital Partners umbrella. And so since 2019, him and I have really been leading the capital market side, and I really raise capital equity for a lot of deals, as well as the debt side, which sometimes we raise private debt, but most of the time getting financing from banks and credit unions and whoever is a great fit for the project we're working on.
Got it.
So I'll kind of pause there, but that's kind of my background leading up to joining MAG Capital Partners.
Yeah. It sounds very serendipitous, right? You started as an LP, then you got more involved, you became a partner, and then you eventually joined the firm directly. So, and they got a 2-for-1 with the Walgren brothers.
I just wrote his coattails in. He had a long relationship, and he introduced me there, and we were a good team, and always have been. So it's pretty cool. If you ever work with your family and it goes well, it can be the greatest thing. I've obviously heard horror stories. It's kind of like a business partner, right? It either goes very well or horribly wrong, and things have gone really well.
Yeah. Who's the big brother?
He is.
Okay, got it.
A little wiser, less charming though.
Certainly. Awesome. Thanks for sharing that. I think the takeaway for our listeners there is going to be, if you hustle and make relationships, like, you just never know where something might lead you, and lead to something very fruitful in your case, right? So building your community and always working on that is such a critical thing. And so Peter and I very strongly believe in that, personally as well as professionally. So thanks again for sharing that.
Those meetings, those meetings can take your life in such a different direction. And I think about that all the time. This meeting I take, who knows, right? It could absolutely alter the course of your life, and you just don't know it until years later. It's pretty amazing.
Yeah, absolutely. So tell us a little bit about MAG Capital Partners specifically. What's your business model? What kind of asset classes do you invest in? To be clear, you guys are primarily real estate private equity firm, but I know you focus on an asset class. So tell us about that.
Yeah, absolutely. So as a firm, started in 2015. The two founding principals had both been in commercial real estate for a long time, and brokerage and developments, and even some experience on the appraisal side. But really, since 2015, we've grown our portfolio. Today, we're managing about 1.2 billion in assets under management. Team's about 27 of us now at this point. So it's been a great ride. But really, since early onset, I mean, really our first endeavor in our asset class of choice, which is industrial real estate, was in 2016. And we've really found a niche there. And so we primarily, on the real estate side, invest in single tenant, triple net leased industrial real estate across the country. And most of the time, these assets are backed by a tenant who's in the manufacturing or food production space or food processing. But a lot of privately held middle market manufacturing companies that are making widgets and parts. And really, we're what's nice about long-term net leases is you don't have to have a ground team at each one of these assets in each one of these markets. So we really have the luxury of being able to cherry pick the best deals we can find across the country.
Quick question to that is it just particular certain states or just anywhere? I know you meant.
Yeah, no, it's a great question. And honestly, we're pretty agnostic about location. We feel like, hey, we can find the deal, a good deal in any location, but there has to be some other factors that make up if it's for a tertiary location versus a primary location. So what's interesting is we find that our deals just over the last 10 years have sort of clustered in a few regions, the Rust Belt and Midwest. There's a lot of opportunity there. There's a lot of manufacturing companies there. And if you sort of drew a line from Michigan to Texas on a map, you'd see a lot of these assets. But we have assets, believe it or not, in California, New York. These are less common for us because we're typically looking for yield and cash flow. But more and more we've seen in the Southeast. But it's really spread out. You just see a lot of clustering in that, Rust Belt down to Texas region. And again, I think that's just more of a reflection of where manufacturing is really heavy in the U.S. So, I kind of, mentioned earlier, Chihiro, about the private equity side, and I'll just kind of add this layer here. But about 4 years ago, after having a lot of experience evaluating single tenant properties where the risk is on the tenant default risk, where you say, look, we have a 20-year absolute triple net lease with no exposure to expenses, annual rent bumps, and 100% occupancy. This is a very nice deal. Where's the risk? And it's all around this private credit tenant and their ability to stay solvent and pay rent. So we always waddled and quacked, as I like to say, like a private equity group, where we dissected this company that's privately held, and we'd have access to all their financials, and I'll get into how we're acquiring these in a bit. But really talking to their management team, looking at the industry that they're in, what kind of debt they're using and leverage, what's a private equity sponsorship if they're owned by a private equity group, and understanding that and getting to know them quite a bit as well.
I see where this is going, Drew.
Yeah. So yeah, you rub shoulders with the private equity groups for a long time. You learn a lot, and see kind of where they have access to capital, where that's coming from, what their business plan is. Right? They always have a plan with these companies. It's not when they're family owned, they might not have a clear plan. The private equity groups are very clear in their plan. So we're going to get to know that because we want to see what they're planning to do with this company. Hey, we're going to use leverage to buy other companies and roll them up, or we're going to introduce new product lines and hit different markets that the company never had access to. So it could be a number of different strategies, but at the end of the day, we saw a lot of real estate deals that were tied to an M&A transaction. And I should stop there and emphasize that how we're acquiring a lot of these real estate assets are through sale leaseback transactions. So imagine private equity group here is buying manufacturing, we'll call them parts manufacturing companies, in the Midwest, and they have a great target here. they're buying the company, it comes with the real estate, and they're saying, look, we don't want to tie up our capital in the real estate.
Exactly.
Right? We have a fund, the fund may have its own docs that say, hey, you can't have more than 10% of capital in real estate. So, they want to reduce their allocation towards real estate because that's not the business that they're in. And they see a higher return on investment from the business and grow in that. So we become this real estate partner for them where they say, look, as we're acquiring this, we'll do a sale leaseback simultaneous to that transaction where they don't have to tie up that capital for a minute. And for us in exchange, we have this long-term 20-year triple net lease with this operating company. And if they have a parent company, get guarantees from them as well on that lease. And it's a great, sweet deal for us. But I bring this up because, we've seen and still see day in and day out these transactions. We're really close to them. We understand that very well. Hey, are they using leverage to buy this company? Obviously, we want to see post-transaction leverage on the company to make sure they're not in an unhealthy position. But we also saw a lot of these deals fall apart, right? And many times we saw these, and our real estate transaction was contingent on their acquisition. It would fall apart. Hey, things happen, no big deal. But we'd go, look, this is a great company. We're not quite set up, and this is, many at this point, 7-8 years ago, we were having these conversations going, we should have bought that company, right? Yeah. This is a great company. They're going to make a lot of money on this, or, hey, they fell apart. This would be a great time if we could swoop in, but we weren't quite ready for that. We didn't really have the right team on board. And so again, about 4 years ago, we brought over the right guys, specifically one individual who's now a partner on that side. And he brings a lot of opportunities and manages that. And a funny backstory, he used to be the CEO of one of our tenant businesses. He got placed there by private equity. So we had known him for a long time. And from there, we started to identify and acquire operating companies, all still in the industrial sector, since we know that sector really well and see how a lot of manufacturing companies and other industrial companies operate and use, revolving lines of credit, and just very familiar with that from all of our experience in real estate. So kind of an interesting story, natural expansion there. And, a couple months ago, we just closed on our 8th operating company. And, at the end of this month, will be our 9th. So pretty active in the space.
Are you the landlords for any of those 8 companies?
We're not. We keep them separate, but when a few of these are, I'd say about half of them, the company we've bought with the real estate, and we'll keep them side by side under a holdco. And so we'll have the business on one side, but on our real estate side, we manage several funds, and we're very careful not to intermingle those because you have different sets of investors and stakeholders, and it could give you an opportunity for a conflict, right? Hey, what if you own the company and they start to have struggles and default on the lease, right? Now there's a very tough decision there. So yeah, we're very careful to keep those separate, which is the best move.
Yeah. Now for our listeners, let me just recap real quickly what was very interesting about what Drew just said. So they're doing a full, very deep dive underwrite on a potential tenant that they're going to have. And in the process, they're like, oh gosh, this is a great company. Wouldn't it be great if we could own this thing? Well, you've done all this work in the due diligence already, but you don't have the infrastructure yet prior to 4 years ago to actually buy and operate that company. So after those learning experiences, your leadership said, all right, let's create the leadership here where we can do this. And now we have 2 parallel companies doing corporate PE and real estate PE. So amazing strategy, kind of journey and growth for your firm to do that, and a natural path of growth.
Yeah, it's interesting even on the real estate side where, again, you see, what's the risk around, again, owning the single tenant asset that's typically critical real estate, right? We want operational real estate that's critical to an organization. And in the manufacturing side and industrial side, there's a lot of intellectual property, right? And so typically these companies, if they were to get in trouble, and we do a very good job of avoiding that, in 110 plus properties, we've only ever had one default. But if they ever get into a situation where, they're over levered, and usually that's where issues can arise, right? We just took on too much debt and, business took a turn and now we're struggling. And generally speaking, they're either going to go one of 2 ways, most likely. And one is going to be, hey, they're going to sell to a private equity group who's going to bring a fresh injection of equity and turn this around, deleverage the company, get them healthy, And many times, again, it's just leverage, right? Hey, sales are there, margins there, but the burden is too high. But the other situation is a Chapter 11 where they reorganize. And again, you're over leveraged. The banks are going to work with you on that, and the bankruptcy judge, I should say, is going to work with you on that. And typically, they're converting, debt holders to equity holders, whatever they can do to keep the business operating, of course. And so, what's great about that is we hold a real estate where this is a critical piece where they can only reject a lease if they move out. And so we're looking at assets where they don't really have a company without this facility, right? These are their headquarters. These are their main manufacturing plants where, hey, we could get out of this lease, but what would we do as a company? Whereas if they may have a few sites that they operate out of, they might also have a warehouse that they distribute from and say, look, we can consolidate that. That's not as important. That's not an asset we're interested in. We want that critical real estate. So it's now you start to think about, what about our private equity side? Now, this hasn't happened and we have no plans to do this, but just an interesting tool, kind of a mental exercise, right? Hey, what if we have a tenant who's starting to have issues and they do need to sell the company just to kind of keep their employees employed, right? And keep the company functioning. And they say, look, we'll take an exit. We're not interested in pursuing this anymore. What if we could come in and take over the company? And really just to kind of stabilize the real estate side as well. It's a tool that's there. Again, presents a conflict if you have two different sets of stakeholders, but it's just an interesting opportunity that, who knows, one day may materialize. But I
bet someday that is going to materialize. Yeah. It's likely to, I would think. Right.
You don't do this for forever without having, a tenant get into trouble. But we've had a great track record there, and we really focus on very tenured industrial businesses as our tenants, who are typically 40, 60, 100+ year old companies. We're working on a deal closing in a couple of weeks where this company's been around for 140 years. Since 1880, so a little more than that, and it's pretty amazing, right? And I think that's kind of a testament to the industries that they're in usually. And this particular company manufactures gymnasium floorings, right? Boring business. They do the NBA and NCAA and high schools and all across the board, and it's pretty amazing. So you see these companies have been around a long time. They're not high growth, unicorns, right? These are pretty steady organic growth businesses doing between 50 and 500 million in revenue, 8 to 12% margins. It's not exciting, right? These are companies where we go, hey, we feel really comfortable with their ability to pay rents over the long term, survive recessions. They've already been through God knows how many presidential administrations, policies, wars, everything. And again, that's a real testament many times to the industry that they're in. And, a culture probably that transcends layers, generations of management.
Right.
So we've done very good there by focusing on those, and that's a space we like.
Yeah. That's an important nugget there, which is some of the best businesses in the world are very unsexy businesses. Making gym floors, but 180 years in business in a country that's not much older than that, right? What are we, 250 years old? So that's remarkable.
Yeah, it really is. Tenants range from, company that makes chemical coatings for lighting systems to we have a tenant that manufactures headstones and gravestones. You go, hey, isn't this great? They're in the death care business. That's not going anywhere. So
people are still going to die no matter what happens with the AI revolution.
Yeah,
absolutely. So those are the kinds of business we like. And now here's what's interesting, and you guys have a lot of experience on the private equity side. We look at private equity sponsorship as really a credit enhancement to these businesses, right? And there's nothing wrong with the family-owned business, but the private equity sponsorship of these tenants is really interesting because they have oftentimes access to a lot of capital. It can be equity, but many times we see them in a situation, maybe historically or recently, where they either needed to refinance some existing debts or just needed some kind of loan. And many times a private equity group will structure what we call friendly loan, right? They'll say, hey, it's a very standard looking private credit loan. It might be 5 years, fully amortized across 5 years or something like that. But in any case, it's pretty interesting. And we love that too, because you go, look, is the private equity group going to default on their own business, right? I mean, this is friendly credit. They're going to be flexible. They're not going to be hard-nosed. And you see the tools that they use. But yeah, it might be an equity injection. Hey, we see some opportunity for these guys to really expand into a new market. We're going to invest another 20, 50, 100 million, whatever that might be, in equity to really maybe it's acquire new equipment that's going to allow them to expand into that field, or more efficient equipment that's going to double their output, or whatever that might be. They have access to that capital. They have the ability to seize the opportunity, or just get them through a speed bump, right? Hey, there's a couple bad quarters. It might have been COVID, right? Any kind of periodic event where, hey, we're going to be fine. But, as many of folks much wiser than me have said, businesses don't run out of business, they run out of cash, right? So that's an important thing to keep in mind. And when we see these sophisticated sponsor groups above our tenant business, that's a great thing.
Yeah. I have a question. I know you answered this as far as manufacturing, the types of manufacturing, but do you guys have a focus on certain niches in manufacturing companies, or is just really open to any manufacturing companies?
Really open to it. Again, most on the real estate side, we're looking at sale leaseback opportunities, and we have a reputation there of being able to execute. So the private equity groups even, but the full brokerage community that focuses in that space knows us, knows what our capabilities are, and that's what the sellers are usually looking for, is certainty of execution. So we'll look at the deal, and what's the funnest part of my job and our business is learning about these companies, sometimes in industries or spaces you never even knew existed, right? And so you just start to dive in deep, and we have a full in-house credit advisory team, so they're usually first in there. And then of course on the capital market side, as we've got a signed LOI, and now we're pretty deep in due diligence, I'm starting to work on equity and debt, and I'm learning about this business, and it's fascinating, right? You find these businesses, and again, we're going to be a little agnostic there, dive in. I'd say, if anything, there's a couple industries we try to avoid or have too much concentration in. One would be oil and gas, upstream companies that just are a very cyclical industry. We stay away from it. If it's downstream, if it's distribution, maybe, right? You start to think, okay, we'll look at it. They're a little more resilient. But outside of that, it's really looking at concentration and managing that portfolio across several funds even, and individual deals we've done in the past, but managing our own exposure to, namely at the top of the list is automotive, right? I mean, that's the biggest manufacturing industry in the world, probably, but certainly in this country. So you really want to watch that. And most of these guys are, parts manufacturers. We're not doing sale leasebacks with Ford Motor Company, but these are companies that support that. They might do plastic injection molding and make glove boxes and other housings. You have to keep an eye on that and make sure, hey, we don't have, 4 or 5 in a row that are all related here to the same industry. But honestly, it's pretty natural to be diversified across these industries. Just in that there's so many manufacturing companies out there doing so many things. And again, it kind of happens naturally, just in the type of exposure and deal flow we get.
Yeah, a long time ago, I came across a company that were looking to exit. It was a mulch. And I was like, oh, I had no idea, so even though I see it on my house, right in front of my house, but never thought of that. But there's so many things out there, manufacturing companies that exist, and we don't even know. So
sure. Yeah. And you'll find a company. I mean, I'm just thinking of a recent one in Alaska, and we're not moving forward with it. By the way, very difficult to do business with folks in Alaska. They're they're not big fans of the mainlanders over here, right? So
all right.
I can see that.
It was an asphalt manufacturer, right? They're doing, $100+ million a year, and all they're doing, you see the big piles of ground up, aggregate, and you go, okay, and you start to look at the business, and you realize, hey, Alaska is a very big state. It's the biggest state, and there's a lot of roads to pave, and there's a lot of undeveloped land, and what a great business, right? So you really start to see the big picture there. But yeah, I think what's interesting in this space, and especially when we structure private equity acquisitions and present those to our investor group, is everyone has a story where they've heard, my buddy Tommy's uncle, he was extremely wealthy, and he had this business and they made fence post caps or something really boring, right? It's always an example like that where it blows people's mind, right? Hey, they made this boring product and, they churned out again, 100 million in revenue a year. And the owner of that company is very wealthy and maybe sold the company to a private equity group at some point even. But everyone's very familiar with that story. So when we bring that to our investors, hey, we're buying this boring industrial company that's very stable. And people say, that's awesome. I want to own a very boring company that I know is not going to fall flat on its face. And as long as we see that opportunity and communicate that well, people will see that and go, okay, this is great, right? This is an established EBITDA positive business. So that's, and just to add to that, our buy window, our businesses that we bought have been anywhere from 15 to 45 million in revenue. So these are small to mid-sized businesses doing generating positive EBITDA from anywhere from 1 to 7 million or so in EBITDA. So that's kind of our buy box, and we like these established, profitable businesses that we see opportunity for growth.
So I know your principal area of focus at Mag Capital is capital markets. So I want to talk about debt and then equity. So with debt, what's your kind of typical financing acquisition debt that you have? Like, what's the maturity, rates, all those types of details.
Yeah, I mean, I'll kind of keep it focused on real estate for now, but really,
real estate.
Yeah. It's typically fixed rate debt, and you can imagine why, right? We have a lot of fixed inputs. We don't have exposure to expenses, 100% occupancy. So I always say, why ruin that with a floating rate debt? So yeah, we typically use fixed rate debt at a term of 5 to 7 or 10 years. They use 7-year term oftentimes just to tie that to a 7-year treasury bill. So that's generally what we'll see, but a minimum of 5-year fixed rate debt. So, we've had a very stable portfolio the last few years where a lot of groups have had some struggles with shorter term debt or floating rate debt. So that's always been a conservative debt, business plan for us, and it's worked really well. And again, the idea there is to generate sort of a bond-like yield, right? That's very well protected on every side. And you go, we don't have.
And is that interest only or interest only period?
Typically fully amortized, 25-year amortization, maybe 30 if we can get it, but oftentimes it's 25-year. And, if you see a deal, hey, we like this deal, we think we're getting a great cap rate on it, but still a little bit thin on yield, we might say, look, let's get 12 months of interest only. And then the first annual rent bump, you kind of build out of that, switch over to fully amortized debt. So there's some creative ways you can do that. And within our funds that we manage, we'll sprinkle in a couple fully IO payment loans in there. And that's sometimes really just, again, to boost yield, where you say, hey, here's an asset. It's fantastic. And it's in a really primary location, a fantastic credit. And yeah, we have to pay a little bit of a premium for that, but we're still getting a relatively good deal here. But how do we keep and stay disciplined to our targeted yield, right? And typically we're targeting about 7 to 8% cash on cash in year one. So yeah, we'll sprinkle a little of that in there, but most of it's amortized. And if you go fully interest only, I mean, the yield gets really good, but it hurts your IRR. So we like to be amortized, pay down debt. It's more conservative. And as one very smart investor once told me, using interest only feels like cheating. It's not. If it doesn't pencil with amortized debt, then is this a good investment?
Right.
And I think at least for our
or
space,
more importantly, what kind of risk are you taking on? So
right. Absolutely.
Yeah,
so
right, a lot of operators right now are getting into trouble because they had an IO loan, but look at what rates are right now compared to what they probably bought at, right? So that point is well taken. So let's talk about equity then. I know you do raise capital from high net worth accredited investors. Do you also take institutional capital? Like how do you finance your deals on an equity side?
Yeah, it's a good question. In our funds, I mean, we're on our third industrial real estate fund now, and we have a blend coming in at the moment. So, high net worths, anywhere from, $100K to whatever their checkbook can support, and then starting to see more and more family offices in that, $1 to $5 million commitment size. And we're, right here at the moment, starting to bring in this institutional capital, we'll call it $10 to $50 million or so in that check size range. So yeah, it's really cool to be able to have that. And of course, there's some different economics depending on check size for those investors, and some expectations by an institutional check writer that, hey, you're going to have a more attractive management fee, splits, all of that, and that's just, again, expected at a large check size. So yeah, very different groups. They're very interested in different things.
Yeah. So you can discuss this in the context of your current fund or your previous fund. But what percentage is high net worth retail versus that small family office, 1 to 5 million, versus institutional 10 million plus?
Yeah, our first two funds are probably 80 to 90% high net worth individuals. And I'd say the rest of that is generally family offices. And we really kind of tweaked our structure because after years of talking to institutional groups, you start to realize, hey, what's important to them? What kind of call structure do they want to see? And a lot of it's just structure, right? They love the investment strategy, but they go, look, we're sensitive to X, Y, and Z. Maybe it's acquisition fee, but they're a little less sensitive to management fee. So you do some tweaking and learning over time just by presenting and having these conversations with those groups. So at Fund 3 at this point, we're going to be more than half of that capital will be institutional capital. So we're kind of moving in that range. And a lot of that just has to do with scaling as well.
Right.
You start to go, hey, our last fund was 80 million. We're going to be at 200 million in equity on Fund 3, right? That's a very difficult scale up with high net worth groups. If anyone out there was raised, almost 2.5 times in your high net worth checks or pool of people, that doesn't happen overnight, right? So starting to blend both those groups together is certainly a good way to scale and be able to say, look, we can now seize some bigger assets, bigger opportunities, and still be well diversified.
Right. Yeah, I've been seeing a lot more activity from the family office working with private equity. But I could correct me if I'm wrong, but I've been seeing that a lot. So definitely.
Well, I'll tell you, I just came from a conference in Miami, iConnections Global Alts, and it's almost all institutional capital. There's, minimum check size from those allocators out there is, 2 million or so, right? And going all the way up to 100 million or more. And these groups, in these conversations with us, looking at real estate, really positive to hear that a lot of them are turning the corner on real estate. They go, look, last year we weren't even interested. We wouldn't even take a meeting with someone who's in real estate. And they're very positive on that. And I think there's a little bit of a portfolio rotation going around where they're going, hey, public markets are highly valued right now. We're interested in, reallocating a bit, and we see some opportunity now in real estate. So for anyone out in real estate out there, it was a great thing to hear that the institutional mindset is starting to be much more open to real estate, where the last couple of years they've done very little allocation.
Right.
Yeah. Thing about real estate is it's not a monolith, right? Those investors that told you, yeah, we're not touching real estate right now, or told you that, surely they had office and multifamily exposure, right?
Right.
But warehousing, logistics, supply chain, right? The industrial stuff that you do, and then of course data centers. That's never stopped being red hot. Like and do you see data centers like taking a dive anytime soon? I certainly don't. Right. And
I don't think so. There was a flash there with Deep Sea came out, and everyone thought, oh, good Lord. And I just came from this conference I mentioned a couple of weeks ago, and Deep Sea, the news just broke out. Hey, maybe we don't need these giant data centers to support this AI operation. And I did get quite a few people ask, well, in this, real estate fund, are you also in data centers? It's technically industrial real estate. Yeah. And we said, no, that's just not a place we found a lot of opportunity. And people were starting to worry there. But I think it's going to be fine. I think people are realizing, hey, this deep sea operation wasn't quite as efficient as the company or China was sort of letting on. No surprise there, a little bit of hyperbole maybe from them. So I think they're realizing, look, the need for these data centers is not going anywhere. So that space is interesting. I think if you're a ground up developer, I'd absolutely be looking for opportunities there. And it's really just a matter of power. Right. That's what it all comes down to, is location and access to power. That's it.
Exactly right. The constraint is energy when it comes to that particular asset class. But
I think it'll be hot for some time, though. Just to clear that up, cold storage is a great sub asset class we like a lot. The cost of construction is so high that if you can buy an existing asset, B or even C class asset, and make sure that the capital or the tenant, because these are absolute net leases, they're responsible for that. They're ready to make sure they're taking on that capital cost there. But yeah, if you can get a B class, cold storage asset under replacement costs and still generate some yield, that's a great one, because there's such little supply. Because frankly, the rents are so high based on construction costs that there's kind of a smaller field of potential tenants. Right? It's very expensive.
So the food industry as a whole, inclusive of cold storage, is interesting, right? Because it doesn't matter how globalized the world economy becomes, we're not going to be shipping frozen pizzas from like Taiwan. Like it just doesn't make sense. They need to be closer to where they're consumed because of the cost of transport and whatnot. So absolutely love your business model in terms of identifying those really just solid businesses that they're not going anywhere. We're going to keep building gyms. We're going to need cold storage. And so those are enduring business models that you are targeting for your tenants. And so I think that's a really strong story for you in terms of your investors.
Yeah, we don't have any plans. I mean, we talk about this occasionally, and I think every sponsor group out there should, but you go, hey, will there be a time in the next 5-10 years that you pivot, right? I mean, it can happen with any asset class, and I've seen other operators do it. Hey, self-storage is too crowded. We're pivoting, and it makes sense sometimes. But honestly, we have no plans to. We feel like that we have at least 5-10 years of great runway ahead of us in this space. And then you see this trend of deglobalization happening. It's been happening really since COVID, and then we have Trump in office now, and he's certainly leaning in that direction too, right? He wants to support American manufacturing. So we see a lot of tailwinds looking forward. We see a lot of companies saying, let's mitigate our risks on our supply chain. Let's start to bring those back home. And it's all just increased demand. And then kind of behind that, I would see this foundation of just continuously increasing e-commerce. And it's not going to jet set like it did after 2020. I mean, that was like the gold rush, or like a land staking. People were just frantically getting as much distribution space as they can. But there's this very steady growth in e-commerce sales, and all that has to get supported by logistics and industrial warehouse spaces. So there's this very kind of nice foundational support for industrial real estate. And so, again, you look at all those trends, I wouldn't even call them trends, structural changes that we see and feel like we're going to be in place for a long time. We think we'll be in this space for a while.
Wow, that's definitely some good stuff to know. They're talking about data centers. I know the thing that popped in my head was I think Midland or somewhere on the east of Texas they're looking to build out a huge data center there. So
Abilene.
Okay.
Abilene, West Texas. Yeah. And I'm on the west side of DFW over here, not far from me, about an hour and a half. But I think that's where the Stargate project is going to go. That joint operation with OpenAI and Microsoft and a few other companies. And I would love to go drive over there and check that out, because it's probably a monstrous operation. And I, these guys, I don't know about that operation, but we've seen some government subsidies promoting more manufacturing, specifically the CHIPS Act. There's a giant development in Phoenix, for instance, for Taiwan semiconductor plants. Micron, I think, has one somewhere around Cleveland. I could be wrong there, but Texas Instruments, right in that north corridor above Dallas, where you guys are at. There's quite a bit of that going on. So, does it affect our investment, on an individual level? Typically not, right? But it's just cool to see this support and this general trend towards, hey, we want to support American manufacturing. And a lot of that CHIPS Act is really just taking our reliance off Taiwan and some of these other countries, right? But that's across the board with a lot of these supply chains, where companies saying, hey, we cannot be reliant on a supply chain that's on the other side of the world. And it might have nothing to do with, a power struggle between, an adversary in the region. It might just have everything to do with the 1,000 layers of risk between there and here. It might be dock worker strike. It's a shipping channel that get disrupted by pirates off Somali or a volcano. I mean, all of these add just to all the potential risks that are kind of hard to calculate. So some of these companies are even paying a little more for manufacturing or a supply chain supplier in the US, but they're saying, look, we're not going to get stuck like Ford did after 2020 with a fleet full of trucks, no semiconductor chips,
right.
That kind of stuff just rains hell on a company and is way more damaging than, a 10% increase in cost.
And an important point to make with respect to reshoring of manufacturing jobs, this is something that's transcending just Trump versus Biden. So you brought up the CHIPS Act and the manufacturing of a chip semiconductor facility in Phoenix. That was signed into law by Biden. So this is, Democratic president, Republican president, there is a structural shift. I'm in agreement with you, Drew. There's a structural shift towards bringing manufacturing here back to the U.S.
Yeah, I think the government and our people should be terrified of China taking Taiwan and having control of, what is over 50% of the world's semiconductor chip manufacturing. And you go, okay, so our military and fighter jets depending on these, and if you were in a conflict with China, where would you be, right? So it's just as important as oil independence, right? So it's I think every American should agree with that. Hey, let's bring some jobs here in the meantime, and not be up a creek if we really need these.
Xi Jinping has he's not tiptoed around this topic at all. The Chinese government is very clear. They intend to take Taiwan. That is their position officially. We don't know when. Will they actually do that or not? Obviously, we don't know, but that is their official position. So it is absolutely a massive geopolitical risk, to your point. Well, hey, this has been fascinating, Drew. I want to make sure we ask you, if we've got an accredited investor who's interested in what you've taught us about your business model today, how do they reach out to your firm to learn more?
Sure. They could email me directly, drew@magcp.com, which is right on the banner down there on the screen. I think every viewer should see that, but drew@magcp.com is my email. And, reach out if you just want to set up a call, learn a little bit more. We have a lot of opportunities on both the real estate and the private equity side. So if you're interested in participating, reach out. Let's chat.
Amazing. Well, thank you very much, Drew.
Thank you, Drew.
Yeah, learned a lot, and it's very attractive. I'm personally interested. I've been in touch with Amanda. We've emailed back and forth, so I may very well be an investor of yours sometime in the near future.
Well, great to see you guys. Yeah, thanks for having me on. Love to discuss this stuff. I know in the past we've talked about private equity and businesses and roll-ups, and always enjoy it. And people think that guys like us, just do this for work, and I find myself, if anyone isn't too bored by talking about it at a party, just businesses and ideas and structuring these things, and then usually people roll their eyes and walk away. But I love this stuff, and always good to talk.
Business nerds unite.
Yeah.
All right, Pedro, you want to take us out?
Yeah. So if you have any questions, again, you can send us a DM if you're on LinkedIn, Facebook, or even YouTube. You always send us a message. And if you need to connect with Drew, we can definitely connect him with Drew. So other than that, stay tuned for the next show. Thank you.
All right. Thanks, guys.